How can a charity sustain a loan and credit? Famously, the world's most successful financial investor, Warren Buffett, expressed skepticism on social investment. He questioned the capacity of charities to run themselves like businesses, a necessary condition for the incurrence of debt. In particular, in 2013, Buffett expressed his dilemma thus: "I think it's tough to serve two masters. If I set up an objective of running a business as well as I can, I have to work through hundreds or thousands of people to get my objectives achieved. I think giving them two different goals can be tough. So I think I would rather have the investing produce the capital to then have an organization totally focused on the philanthropic aspects." Buffett, no fan of social investment, but he has instead gifted a large share of his legacy to the primarily grant-giving Bill and Melinda Gates Foundation. Certainly, lending to a charity as though it were a business demands a great deal of thought. In fact, social investment fund managers will carry out a comparable level of credit analysis on a charity to that of a traditional credit fixed income asset manager. The amounts being lent are often a fraction of the size, but the damage caused by making poor credit decisions are amplified by the impact on vulnerable people who may lose their entire support mechanism. Equally, the charity is likely to have credit characteristics that are distinct from companies, making the credit profile weaker. For example, charities have no means of raising conventional equity, but instead rely on building up reserves through surpluses or by attracting grant funding. At the same time, they are reticent to build substantial reserves, since this can inhibit future grant funders from giving. Funders may view large reserves at the charity as a sign that the charity has less need for scarce grants. Other donors may have similar concerns. This leads to a requirement to maintain unrestricted reserves and cash at a maximum of 3 to 6 months of operating costs. Reserves, unlike a company's equity base, are simply a buffer to manage short-term crises. In fact, charities will often maintain property valuations at historical book levels to disguise real reserves. This means that conventional gearing levels at charities that borrow can be very high, but work needs to be done to analyze opaque balance sheets. At the same time, charities may have less continuity of cash flows in a company. Contract payments from local authorities are uncertain, and commissioners are prone to cancel contracts unexpectedly. Furthermore, the burden that charities have taken on from government during austerity has left these not-for-profit institutions still more exposed with other liabilities. For example, in bidding to provide traditional welfare services from local authorities, some have incurred onerous defined benefit pension obligations in pooled local authority pension schemes. At worst, these liabilities can be last man standing, with the requirement to pick up the payments of failed members of the scheme. So, the credit analyst looking at charities needs to be alert to risks that amplify traditional credit risk. In small and medium-sized charities, where the impact for investors can be greatest, the profile and experience of the CEO and key trustees is indispensable for the business. Continuous financial scrutiny at board level and the charity's philanthropic profile can temper worries around high leverage and vulnerable cash flows. But as Kids Company and other high-profile failures have shown, charismatic leadership is not enough. Transparency around financial sustainability and social impact is essential. Kids Company, after all, spent nearly £50 million of government money by appealing to a celebrity funding culture, removed from any proper scrutiny. The financial and impact scrutiny which accompanies the provision of social investment arguably makes these accidents less likely.